The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to the third webinar on incorporating your legal practice. My name is Matt Schlyder. I'm a chartered accountant in Brisbane who spends a lot of my time working with law firms in terms of their personal affairs as well as helping them grow and develop their businesses. Today, we're going to be looking at the upside for your practice and the long-term return of incorporating. The previous two webinars that we've run, first one was on was a bit of an overview, with the second one being focused individually on the principles of law firms. What I'm going to try to do today is pull all that together and run through a little bit of the issues that you need to be aware of in your practice, as well as looking at what incorporation can do in terms of your long-term wealth creation and growth for your business. So just to get us started, I'd just like to get a bit of a feel for who's previously attended these webinars. So I've just launched a poll there, so if you can just let me know if you're a none or a one or a two. Excellent, almost done. So we've got, it's good to see we've got almost 2/3 of the people who are attending today. This will be your third webinar, so thank you very much for continuing on. A little bit of news for everybody that due to the great success of these webinars and the feedback that I've received, I'm actually going to start a monthly webinar series specifically for law firms on a whole range of topics. And over the next week, you'll receive an email from me with a very simple little survey that that is asking you to provide me with some feedback on what sort of topics are relevant for you. We'll be running these webinars just on a monthly basis, towards the end of the month, and just for a 45-minute session, and they'll be recorded and available for you as well. So thank you very much for participating today, and welcome back. One other little poll just to get a bit more context for who's on the line. I just want to get an idea of how many sole practitioners we've got, how many partnerships, and how many people already in ILPs. Okay, almost done. You just put those last votes in. Excellent. So we've got 41% of our listeners today are sole principals, with 53% in a partnership, and 6% of you are already in incorporated legal practices. For those of you incorporated legal practices, I'm going to touch on a number of things today that you need to really have on your checklist, just to make sure you've got these things sorted out. Particularly if you are if you have a number of principals in your ILP. So let's get started. So what we're going to address today is looking at your ILP and putting it in the context of what you need to be doing to be financially well organised for your practice. For those of you who have attended the prior seminars, this is the philosophy that we use here to make sure that strategies that our clients implement are aligned to what their goals and objectives are, and are focused on ensuring you've got a very strong foundation plan in place, those green areas, and that it aligns to what your long-term goals and objectives are in terms of your blue areas. So thinking about an ILP and applying that to a practice, we've got to think about our goals and objectives. So we're going to talk about, why do it? Why incorporate? From an estate planning perspective, what happens upon your death, because you now got shareholders in this vehicle. Do you have a shareholders agreement? We'll look from a risk plan perspective within your practice. insurance on death, disablement and illness. We'll discuss from an asset protection perspective the limited liability benefits of an incorporated legal practice, as well as by incorporating, removing that joint and several liability. Look at the taxation planning opportunities that exist within your company. The 30% tax rate, ability to income split, but also the cash flow impact of that, as well as the benefits that come from structuring some of your debt into this practice. The ability to use the business as security with the bank, and also the ability to repay principal out of 70% of after-tax profits. From there, it helps from a retirement perspective. So for those of you who are considering an ILP from a succession perspective, how that works, and then also from a business planning perspective, I'm going to run through with you to bring it all together to show you how, if you're able to retain a greater amount of your after-tax profits, how that can compound by reinvesting that within your business over the longer term. So that hopefully gives you a little bit of a context as to the topics we're going to cover off today. So first of all, an ILP. So for those of you, once again, who've participated in these webinars, an ILP's got a whole range of benefits. So from both the personal perspective, but also from the business perspective, provides limited liability, tax rate of 30%. It allows you to have a shareholder as a trust, income splitting, and so on. So there's a whole range of benefits there. So to recap from our first webinar, the mechanics of when you restructure your practice into an ILP, generally this is how it works. You've got old practice goodwill, there's old practice fixed assets and the staff and the leases, etc. Those are the assets that get transferred or sold into your incorporated legal practice. Usually what happens is the existing WIP and disbursements plus the old practice debtors, they stay in the old practice and get converted and collected over the coming 12 months or so, depending on the type of practice you are. You know, if you've got personal injuries work or family law matters, some of those files may take longer than that to convert. But basically, you leave your WIP and your old debtors in the old practice, transfer your goodwill, fixed assets, and your operating assets and staff arrangements into the ILP. So we're just going to look now at why you have an ILP. You really need to have a reason to do it if you're considering restructuring. If you're a new business owner and you're just thinking about setting up your practice, there's no reason why you wouldn't just do an ILP to start with. There are rules that we've covered off in other webinars about the ability for a company to retain its profits or pay it out to the practitioner as wages. But if you're a new business, you just set it up anyway, because it's easier to do that right at the beginning than to go back and restructure and change it later on. But for practices that have been set up before 2007, or even in more recent years, who are considering incorporating either a sole practitioner or a partnership, you really got to think about what your goals and objectives are. You got to think about why you are doing it, because sometimes the reality is that there is no benefit or no additional benefits. It is just costs you to actually set up an ILP. So you need to do that assessment. So you've got a clear context as to why you would do it prior to heading down that path. You'll see at the end of this webinar today, there's an offer that I make to all the participants today to book in a free 45-minute telephone consultation to review the applicability of ILPs to your practice. And look, there are a number of you who are listening in today who have taken me up on that offer. So thanks again for your support. But in a number of those instances where I've spoken with people about this, there hasn't been a reason for them to do it. In fact, it just creates another layer of complexity for them. So you need to have a reason. So don't just do it because you can. You need to make sure it makes sense for you. So if we look at now the estate planning issues from the practice's perspective, you've got to realise now that an ILP can have non-lawyer shareholders. In the past, if you're a partnership of individuals, then or even if you're a partnership of trusts or a partnership of individuals and trusts, for a practice to operate in that partnership structure, it needs to make sure that the partners are legal practitioners. Whereas if you have a company, those shareholders don't need to be legal practitioners. So if you think about what happens on the death of a shareholder, a principal of a firm that's got a trust as a shareholder, that trust can continue on owning an interest in that partnership. So my experience as an accountant is that we're always last to do all our financial statements and tax returns. We do all our clients' work first. My observation with lawyers, my experience with lawyers is that lawyers are last to do their own legal work. So I think it's really important if you're going to go down an ILP path and you've got more than one shareholder, make sure you really put it at a top item on your list to get a shareholders agreement in place that clearly addresses this issue using put and call options and all of those type of things. And the other thing, if you are you need to consider who the appointor of any trust is, so that if you for some reason allowed a practitioner's trust to remain as a shareholder in the business, you need to understand who is really going to be in control of that shareholder. So just a couple of points there from an estate planning perspective. Moving on to risk plan. Risk is basically making sure that if the worst happens, there's death or disablement or illness or injury, that the business will continue on. So if you're a single principal, you may need to consider some key man style insurance or business expenses type insurance. Get that in your business so that your business can continue while you recover. If you're a multi-principal firm, key man insurance is also definitely an option there. Business expenses insurance as well, but also you need to have life and TPD on a buy-sell. Just going back to if you're a single principal, if you were to die, your practice will still need to have appointed another legal practitioner for it to be, as a director, for it to be able to continue operating that practice. So risk planning is very important also from the business. An ILP will provide you with corporate limited liability. And this is, I think, one of the main attractions for incorporating your practice, particularly where there are partnerships, because what it does, it removes that joint and several liability that exists within your partnership. Look, it doesn't remove the risk from the past, say from a claims perspective, but moving forward, it removes that joint and several liability. And the other thing from an asset protection perspective, it ensures that you've got the ownership of your interest in the ILP. You can do that via a trust. So where you've got assets that are in your own names, at the moment, if you're a sole principal or you're in a partnership of individuals, then your assets can be at risk. So what an ILP does, it provides you with that layer of protection. Sure, you've still got to have all the same duty of care and due diligence and diligence when you're conducting your affairs as a lawyer, but it just adds you with that extra layer of asset protection. From a tax planning perspective, this was a diagram that I put up in the last webinar, and it basically shows you the difference between operating your practice as an individual and how you get taxed, and also if you've got, say, a service entity, how you get taxed, or if you've got a partnership of trusts or you are you've got partners in your partnership that are trusts, how they get taxed as individuals and how it compares to a company. So these will change on 1st of July thanks to the carbon tax. At 6,000 is going to move out a little bit further to just over 18,000. But generally how you get taxed is on a marginal tax rate basis. Whereas from a corporate perspective, that company tax rate's at 30%, which means that you can earn about $140,000 worth of income as an individual before your average rate of tax ends up being about that 30%. However, if you look at how you can manage your tax, what a company does, it gives you choice. If you're an individual, whatever the profit is that you make, that profit automatically gets taxed to you at those rates via a sole practitioner or as an individual partner. What a company does, it provides the opportunity to manage your taxable profit distribution. Because what happens in a company, it just gets taxed at 30%. And then upon distribution, it flows through. But if you can look at this line here where that arrow is, you can defer the timing of a dividend payment. So if it's not appropriate for the company to pay those dividends out in 1 year, then what you can do is you can defer that dividend payment to a following year. And by deferring it, it means that if there is any additional tax that's payable, or if in a following year, as a shareholder or the beneficiaries have lower other taxable incomes, you can actually manage the application of those marginal tax rates to that income. So from a corporate, managing tax from a corporate perspective, by having a company that's got shareholders as trust, it really provides you with that flexibility, and that flexibility around managing your tax. The other thing it does, it allows you to change in the initial years the way in which your tax is paid to the tax office. So I've got another slide here from my previous webinar, which just shows you the timing of how all of the tax is paid by individuals. But if we have a look at that, the bracketed part, basically if you were to say restructure your practice on the 1st of July, because that company, and it's a new company that hasn't lodged any previous tax returns, because that company doesn't have a previous tax return, it's not in the PAYG installment system. So what that means is that company gets some tax cash flow relief, and it's not due to be payable until that company's first tax return is due to be lodged, which is going to be about nearly a whole year after the lodgement, the completion of that first year of income. So right out there to 15th of May 14. But what a lot of people don't consider is that they forget to save for it. So even though the company isn't getting an instalment notice, there will still be tax that will be payable. And what you've got to remember is that when you're in a company, that tax will be payable on an accruals basis. If you're already on an accruals basis in your own name or in your partnership, then you're paying tax based on the timing of when you bill your clients. But if you're on a cash basis in your own name, you don't have a choice. You automatically start paying tax, provided you're allowed to retain profits, on an accruals basis. So you've got to be very mindful also, because you may have a cash basis on your old WIP and debtors sitting outside of the company, that as that WIP is billed and those debtors are collected, you'll be taxed on those personally, as an individual. But then on the billings basis within your company, you will also start forming your taxable income. So you really need to consider what your WIP and debtors balances are, and the tax implications of what that means for tax payable in the company once you incorporate, and also then the timing of your tax payments. So PAYG Instalments is, whilst you get that little tax cash flow holiday, it still remains a debt. So please, if you're going to do it, make sure you save for your company tax bill that's coming up. Moving on to a debt plan now, and what I call a debt plan is basically making sure that you have the maximum amount of tax deductible debt and the minimum amount of debt that is provided as minimum amount of other assets that are provided as security to the bank. In the context of incorporating your legal practice, what will happen over the period of time as your practice grows, it will fund debt. It will fund the growth in WIP and debtors. And of all the conversations that I have with lawyers, and when I look at practices, there is a significant amount of capital that is sitting there tied up in work in progress and debtors that I find doesn't sit on the balance sheets of practices. So the number of practices I have a look at that their accountants have prepared a set of financial statements. They've prepared them on a cash basis. So all they show is the cash that's been received from clients in those P&Ls. They exclude out of the asset base the work in progress and debtors. They're assets of the practice, even though they're not taxable until you bill them and then collect them in cash. So the opportunity exists within every practice that has WIP and debtors to consider their funding options. Usually in one and two partner firms, and even in larger firms, that WIP and debtors is funded via equity. There are banks these days, most banks these days are willing to lend to practices, taking a security over the practice against the goodwill of the practice and the practice assets, which include WIP and debtors, which often allows practices to free up cash flow to use for personal reasons or to reinvest other strategies within the business. So from a debt management perspective, it's really important to consider how you're going to fund this growth in WIP and debtors. Because at the time when you incorporate, if you get your debt strategy right, what it may mean is that you don't have to put all of that cash that you've got that's sitting, that you collect by the conversion of your old practice WIP and debtors. You don't necessarily have to put that all back into your business if you've got the right debt and equity strategy for funding that growth. So the other major opportunity from a debt planning perspective for practices who incorporate is that they effectively get to retire debt that exists within that company at a 30% tax rate. And when those principal repayments are made, those earnings can just be retained within the practice so that they don't have to get paid out to the shareholders as dividends and then deal with any top-up tax that may be payable. So on your screen, you can see just the flow of what happens in terms of debt reduction in any practice. First of all, you earn the income, you then pay the interest on that loan, you then pay tax on that net taxable income, so your income minus your interest, and then out of what's left, you have got after-tax cash flow from which you pay your principal repayments. So if that tax payment is lower than what it would be if you were being taxed on that debt outside of a corporate vehicle, basically what it means is you're going to have more after-tax cash to repay your debt. So let me take you through that as an example. Let's say you've got a loan for $300,000 that exists within the ILP, and you want to pay that loan off over 10 years. The principal and interest repayments are about just over $3,500 a month, or $42,732 a year at a 7.5% interest rate. If we have a look at what the free cash flow that gets created out of paying a lower after-tax cash, if we go to the right of the screen and we see I've got a taxpayer there that's paying tax at the highest marginal rate, so he's earning income over $180,000, pays tax at 46.5% on that, and then must pay the principal and interest repayments out of that income. So where you've got a principal and interest repayment that's required to be made, you need to earn, if you're at the highest marginal rate of tax, you need to earn $66,522, pay the interest of $21,790, gives you taxable income. You work at the tax at 46.5, which then gives you after-tax cash to pay your principal. If you add up the interest and the after-tax cash there, that should equal the principal repayments. Although I must have pressed the wrong button there because it's a little bit over. But if you've got less tax to pay, if you're paying 38.5%, then you're going to have more after-tax cash to pay your principal repayments. So if you follow that through, if you're only paying tax at 30%, then compared to 46.5%, you're going to have a greater amount of after-tax cash within your practice to be able to spend either on paying out an additional dividend, or reinvesting back into the business, or retiring debt. So the whole concept of having debt retired in a lower tax environment provides you with additional free cash flow to go and to utilise in your business. I haven't included here any additional benefit that is created to where you restructure non-deductible debt into deductible debt, which is often the opportunity when you look at the equity that's tied up in your practice in funding your WIP and debtors. So that's one major consideration, paying less tax, capturing the income within the corporate vehicle, and therefore having more after-tax cash to apply to debt reduction. Over the long term, then that provides you with a significant better net after-tax position. If you look at it from a retirement planning perspective, an ILP makes entry and exit of partners or principals in a practice so much easier. The number of practices where there's been entry of partners, and that may have been over a number of different years and a number of different entries and exits, where they're running sometimes 2, 3, 4 sets of practice books, keeping track of old WIP and old debtors and who buys what and who owns what. It's an administration nightmare. What an ILP allows to happen is you're able to change your ownership interests by dealing with it at the shareholder level. You don't actually deal with the interests in the assets of the business by themselves, as you do as an individual or a partner. If you had work in progress of $500,000 and you admit a new partner with a 20% interest, then that partner buys a 20% interest in that WIP, and the exiting partners or the selling down partners sell that interest. Or alternatively, they mightn't even sell that WIP. They might, the old partners might retain it, and the new partnership then grows new WIP. What happens with a company is you can just do that via a share sale or a share issue, depending on what's the right strategy for you. And you can do a mixture of those from a principal admission perspective. When a principal exits, you can use a share sale or a share buyback, whatever is the appropriate strategy for you. Just as a word of warning for those of you who have access to the small business capital gains tax concessions, some strategies that people use for disproportionate profit sharing is by using dividend access shares. If you use dividend access shares in your practice, which effectively allow a shareholder that owns a class of shares different to other classes of shares to just receive a dividend to the exclusion of the other shareholders, if you have that structure, then that structure automatically will cause you to fall foul of the small business CGT concessions. The reason for that is you don't have a you won't have a guaranteed fixed interest in more than 20% of the income and capital distributions on those shares. Mind you, you can only access the small business CGT concessions if you have more than a 20% interest. And there's a few other rules that you've got to be careful with in terms of ensuring you continue to access small business CGT concessions. But that's a whole nother webinar in its own right. So bringing all of this together, there's a whole bunch of foundation reasons and personal reasons as to why you might want to incorporate your practice. There's the opportunity for conversion of non-deductible debt, admission and exits of partners, asset protection, all of those reasons that we've gone through in this webinar and the prior to. But fundamentally, if we're looking at our business as an asset that we are wanting to grow and that at some point in time we are wanting to sell, then what an incorporated legal practice allows you to do, it allows you to manage the growth in your practice by retaining a greater amount of after-tax profits to either reinvest back in the business or to retire debt. That allows you over time to significantly improve your net asset position. So that's really the driver. And when a lot of the business strategy work that I do with law firms, one of the first issues that we've got to address is getting the cash flow right within the business, and that usually sits within two separate areas. First of all, we need to get the profits up, but the fundamental issue is around conversion of lockup WIP and debtors and how we reduce that period of time so that there's more cash flow. But if we're going to then focus, you can only improve your WIP and debtors so far. But if it's around driving a greater amount of profit and you want to reinvest that into strategies in your business so that you have got a greater ability to grow your business, then the more of that after-tax cash that you can keep, the more cash you're going to have to achieve those objectives that you're wanting to achieve, to increase the value of your business for when you retire. So let's just put this in a bit of perspective for you. So I'm just going to show you the impact here of reinvesting a higher amount of after-tax cash in an ILP over a 20-year period. So first of all, let's just assume that there's $100,000 of income that's earned. And looking at the difference between the highest marginal rate of tax of 46.5% and the tax rate in a company of 30%. So there's a tax saving there of 16.5%. So if that average rate of tax was 38.5%, there'd be an 8.5% improvement, which would be 8,500 here. If your tax rates, if you've got an income that's taxed at lower than 30%, then going right back to square one, from a debt restructuring perspective, you really have to think about whether or not there is benefit in restructuring already deductible debt from your own name into an ILP. So if we look at this over a 20-year period, so over 20 years with, say, a 3% CPI increase that applies to that $100,000 worth of income, the capital value in today's dollars is $330,000. So that's the extra amount of capital that you'll have invested. The maths on that, very simply, is just 20 times an extra $16,500. But if we looked at year in, year out, reinvesting that $16,500 and then looked at what the returns are that we can earn and how the impact of that grows the value of that additional capital over, say, a 20-year period, it's quite astounding. So if we had an after-tax return on that passive investment of 4%, and that is on that $330,000 or $16,000 $500 each year, every year over 20 years, then on a 4% after-tax return, then in today's dollars, that $330,000 would be worth $446,926. So what that means is if you've got that extra $330,000 to invest and you can earn a passive return after tax of 4%, then the compounding effect of that return and of that extra capital value over a 20-year period is almost $450. But if you're reinvesting that in your business, it might be part of borrowing for an acquisition strategy, or investing in upgrading your IT infrastructure so that you can improve your efficiencies and improve your margins to drive improvement in profitability. And from a business investment perspective, you could increase your after-tax return by each year of 20% of that amount invested. So, if you took that $16,500 and in year one generated an additional $3,500 of profitability after tax as a result of doing it, then $3,300 after tax for doing it, then the compounding effect in today's dollars of that 20% after tax return over 20 years produces an improvement in the capital value of that asset of $2.3 million. And I think this is a very important piece that a lot of firms just don't get, and a lot of businesses in this country just don't get, that the importance of maintaining the maximum amount of your after-tax return and reinvesting that within your business to grow your business has a significant compounding effect. If that number was a 30% return after tax, that number's even bigger. If it's 10%, it's still so much higher than reinvesting a 4% passive return. So I just wanted to finish off on that note to give you that long-term upside. So just to summarise, just before everybody departs, really what you need to be doing is making sure that you understand why you're going to incorporate. You need to consider that in terms of all of your own personal opportunities as well as the business opportunities that it has. Being able to have a higher amount of your after-tax return and reinvest that in growing your work in progress so that you generate higher amounts of profit. I'm not talking about deferring billing of it, but so that you get higher amounts of profit can have a long-term significant increase and impact on your net asset position. So as always, after today, for the first 15 firms to email me, we'll run a 45-minute one-on-one telephone meeting where we'll discuss the opportunities that an ILP has in your practice, specific to your practice. Also, just a little bit of an announcement, and as I mentioned very early on in this webinar, what I'm going to be doing is I'm going to be extending the monthly webinar series, calling it Grow Your Law Firm. So watch out in Proctor for the ad next June, as well as I'll be emailing everybody who's participated today, as well as others, to let me know what you want to be, what topics you wanted me to talk about in your law firm. And also, what I'll be doing is interviewing other practitioners and other professionals who can support you and give you some other ideas for how you grow your firm. Also, keep an eye out for my weekly Grow Your Beans blog for law firms at elliottsgroup.com.au. And please connect with me via social media on LinkedIn, Facebook, and Twitter. So thank you very much to everyone who's joined today, and thanks again for our returning webinar participants. I hope to see you again. Don't forget to send me an email to take me up on my offer of a free 45-minute consultation to analyse the application of an ILP in your practice. So thank you very much, and talk to you soon.